The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Risk on or risk off? Well, it just depends on where you want to look. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. It does look like we have a bit of a turnaround Tuesday, given what we saw at the market open. All right, so let's show you what's happening here. The S&P 500 erasing earlier losses to now extend yesterday's rally up 0.25%. However, the laggards remain big tech. You can see the Nasdaq 100 down 1/5%, dragged lower by chip and software names. The U.S. Treasury market is closed because of Veterans Day, so we are keeping an eye on Treasury futures. You can see that is ticking higher, at least on the 10-year. And Bitcoin remains under pressure, even as equities have recovered. It's really struggled to maintain momentum, regain momentum after that October 10th liquidation event. Romaine?
Yeah, and you're still seeing some pressure in the equity market, and given the roughly 3-year bull run for U.S. equities that was set on path by Nvidia, it's kind of fitting that right now the biggest risk to the rally appears to be Nvidia. A lot of questions today about the wisdom of doubling down on that phenomenal rally in big tech, particularly in light of SoftBank's decision to close its position in Nvidia and deploy that cash elsewhere. Oracle, Palantir, Supermicro, AppLovin, and Micron all dragged down today in just a bit of sympathy. Contributing to the pullback, of course, was also CoreWeave. That's the neo cloud that buys Nvidia chip clusters and then rents out its GPU capacity to others. The company rattling investors after lowering its annual revenue forecast because of a delay in fulfilling one single contract. Now, we caught up with the CEO earlier today, and he was adamant that was a minor speed bump with no bearing whatsoever on what he says is still a massive gap in demand for computing capacity and relative to supply.
You have a systemic shortage of ability to deliver the GPUs, the computing infrastructure for the build out of artificial intelligence. And we have never wavered from that position. We have been very, very clear that, when we look at the demand signals coming into CoreWeave, the totality of that overwhelms the capacity of the market to deliver that, and will continue to do that for quite a while.
And while this conviction is certainly understandable, we should point out the stock rally has been less tied to fundamentals and more to a convenient narrative that is certainly starting to fray, even if the fundamentals, surprisingly enough, are finally starting to actually show up. Derivative strategists at Barclays say put open interest increased dramatically last week. Citi says new shorts dominated over the past few days. And while equities overall are still seeing inflows, tech ETFs like the IGV and the Triple Q, Scarlett, they're seeing something a little bit different.
Yeah, let's show you exactly what that's showing, because sentiment on big tech has definitely turned a lot more cautious in the past week. Here's a snapshot of the fund flows into the Qs, the ETF that tracks the Nasdaq 100. And on Friday and yesterday, so Friday and Monday, the Qs saw more than $5.4 billion in net outflows right here. That's the biggest two-day outflows since the dot-com bubble collapsed in 2000. Now, we pay attention to ETF flows as an indicator of demand, Romaine, but also as an imperfect signal of price action, at least in the short to medium term.
Absolutely. Let's kick things off to the close right now with Ankur Crawford, Executive Vice President and Portfolio Manager over at Alger, who has a wealth of experience in the technology and the AI space. And Ankur, I want to start off with some of the comments that the CoreWeave CEO made on Bloomberg Television earlier today. Whatever was going on with that one single contract, he's talked about this idea, this gap between the computing demand and, at least for what right now, is not enough supply. Are you seeing something similar?
Yeah, I think you see it all over. There's another company called Nebius that reported this morning. And what's surprising is that they're actually seeing an increase in pricing for their GPUs because there's simply not enough GPUs. So people are willing to increase the pricing per hour that they're willing to contract for that GPU. That is incredibly unusual if we were in a supply glut of compute. You heard it from Lisa Su today. Mm-hmm. She's having her analyst day today, and she said there's insatiable demand for compute. Mm-hmm. She reiterated $1 trillion TAM for AMD. You heard it through earnings season with all the hyperscalers that they don't have enough capacity, and in fact their numbers on their cloud businesses would have been higher had they had the capacity. Microsoft said that they will be short through 26. Mm-hmm. So I think there's a lot of different signals that the compute capacity is not meeting the demand signals.
So I am curious. I mean, it's fair as to why people would talk about a bubble, or at least would question it. But I'm sort of drawn to some comments that Chuck Cloud, the famed CIO over at Merrill Lynch back in the 80s and 90s, was kind of talking about the parallels between now and what we saw in the dot-com bubble. And his question that he posed was basically that everyone is asking the wrong question about AI and, more importantly, AI valuations. And I am curious as to what is the right question to be asking right now.
Right. I definitively don't think that the right question is there enough demand? Mm-hmm. I think the right question is probably, can we finance that demand? And are we going to try and build something that's too big, too fast? But do
you think we're doing that?
Not yet. Mm-hmm. And that's the thing. Right now, we've just started this build. I mean, this year we're spending $380 billion on the hyperscale. With the hyperscalers spending $380 billion, next year will be $550 billion. I think as enterprises and sovereigns get involved with this, we can actually start to approach these trillion-dollar numbers. Because the build that's happening is not just an AI build. Mm-hmm. You're taking all of this old infrastructure and converting it into accelerated compute, which is far more economic to run compute that way. So, I think people misinterpret the stocks going up as a bubble. Mm-hmm. However, without realizing that the demand signals are in fact much more powerful than the demand signals were in the 2000 bubble.
I want to go to something you just said. Can we finance that demand? That sounds like the debt markets have a really big role to play. And there have been some concerns brewing in the debt markets, particularly with the collapses of First Brands and Tricolor. And the credit market supposedly always leads. So what does that tell you about how things are shaping up?
Yeah, I mean, even Jamie Dimon said something, well, there's not only one cockroach, right? So I think when it comes to the debt markets are complex, and what I have been worried about is the impact on the debt markets from the private credit side, which they may have underwritten assets that were not necessarily the best assets. Does it actually constrain the liquidity that they have to fund, some of what we're seeing today on the AI side? That is independent of AI. Now, I will tell you the bull case on that. If they can't fund it and we actually can't do this kind of financing, you actually are going to be in supply-demand constraint for longer.
So it sounds like the $20 billion, $30 billion corporate bond sales that we saw from the likes of Meta and Alphabet are going to be a more common occurrence. That's something that we should get used to.
Yeah, I think so. I think that they are going to be flexing their balance sheets. They haven't done this before. And what we have to watch for is to make sure that the ROI that they're seeing from these investments is actually a positive one. So, you think about Microsoft. I think if you look at Microsoft's ROI on the investments in their own cloud, so into Azure, I mean, we think that they get paid back within 12 to 18 months. It is a highly positive and accretive investment for them today. And I think that is a little appreciated fact that the payback periods on some of these assets is actually quite good.
Mm-hmm. So as you're trying to select, I guess either new stocks to get into, or you're evaluating your current portfolio of sort of AI/tech plays, what is kind of one of the main criteria that you look for right now to sort of make that decision as to whether it's going to be a good buy or not?
Oh, that's a great question. I think we had actually we've been in this space and investing in this space for 2 years. Mm-hmm. I would say let me go back in time a little bit. Mm-hmm. So, a company like Nebius. It was the opportunity to go from having almost no revenue to a very large amount of revenue and being the technological leader. Mm-hmm. That's what attracted us to a stock like Nebius, and somewhat underappreciated when we first bought it. And so there's aspects of this market that people are still not investing in, mm-hmm. where the opportunity set is still large.
Yeah.
And maybe, it's a fraction of their business.
One final question, and this kind of has to do, again, trying to draw the parallels, if any, between then and now. We're going to get Nvidia reporting next week, but tomorrow we get Cisco, which of course was kind of the Nvidia of its day to a certain extent. And I know there have been a lot of people talk about all the big infrastructure build out we saw with regards to telecom back in those days and internet infrastructure. Is that unfair to sort of look at what's happening with Nebius and CoreWeave and Nvidia trying to create all these GPUs? Is that just not one and the same?
It is absolutely not one and the same. And everyone wants to point to the valuations.
Yeah.
I look at it completely differently. If you look in 2000, we had dreamed of the world that we have today in terms of having a ubiquitous network. And that ubiquitous network enabled, Uber and streaming video and the cloud. However, if you remember using the internet in 2000, if you could just take yourself back to that moment in time, we were on dial-up. Right, in the late 90s, we were on dial-up, and the experience of using the internet was wholeheartedly unproductive. It was just awful. And so we had dreamed about our world today without a ubiquitous network. We put into place the fiber, the Cisco, networking equipment to enable our world today, but we didn't have last mile. We didn't really have mobile devices that we could use the network as much as we do today. So the infrastructure wasn't in place. Today, all of that is in place. The only thing that we've been missing to deploy artificial intelligence has been compute. And Nvidia democratized that compute by introducing accelerated computation. And in doing so, it's almost like you've been waiting for gas, and now you got the gas and the car can go.
All right, Ankur, great conversation. We can keep going as long as we can, but we got to let you go. Ankur Crawford is Alger's Executive Vice President and Portfolio Manager, kicking us off to the close. When we come back, a conversation about the labor market, a conversation about layoffs with Roger Lee. Stick with us. This is The Close on Bloomberg.
The government shutdown may be drawing to a close, but the patchy data persists. Now, according to ADP research, the labor market slowed in the back half of last month, with U.S. companies cutting 11,250 jobs per week on average in the 4 weeks ending on October 25th. Joining us now is Roger Lee. He is founder of Layoffs.fyi. This is a platform that he created during COVID-19 to track layoffs across the tech sector. So, Roger, clearly one of the persistent fears out there is that AI is going to replace people's jobs in the near term. What are you seeing in your data?
So tech layoffs certainly have been commonplace for a few years now, but the data is actually showing that they're slightly down this year. For Layoffs.fyi, we're seeing that there have been 110,000 employees in tech laid off so far this year, and that's down from 143,000 as of the same time last year. In fact, we've seen layoffs decline every year gradually since 2023, but recently they've been getting a lot more attention because of AI.
Yeah, and I think about Amazon as an example. The CEO, Andy Jassy, had written a memo this year saying that he expects the total corporate workforce to shrink over time because of efficiency gains from AI. But when he was asked about the latest round of layoffs, he chalked that up to a culture reset. So there's really like a shift in the mindset of big tech companies where they're as obsessed with cutting costs as Wall Street banks are.
Yeah, that's right. And every tech layoff announcement these days seems to mention AI. But it's a little more nuanced than that. It's not actually because AI is directly replacing workers today. Most of these layoffs, like the Amazon one, are really about reducing bureaucracy and boosting efficiency. A couple other examples, Microsoft has laid off 15,000 employees this year to reduce management layers. Meta, a couple weeks ago, let 600 people go to, quote, operate more nimbly in its AI group. And then the example you mentioned, Amazon cutting 14,000 jobs last month, not directly because of AI, but actually to, quote, be leaner with fewer layers.
Hey, Roger.
And this is really just, oh, go ahead.
Oh, sorry, Roger. I'm curious, though, too. I mean, are you, in the data that you're tracking, are you able to make a distinction between layoffs of actual people, meaning that these were people in these jobs, or are these just sort of open positions that are basically being eliminated?
These are real people who are being let go, so actual employees being impacted. And it really seems to be a theme of cost cutting here. Companies trying to get leaner, not necessarily just more automated. And there is a connection to AI in this. It makes sense. These companies, these big tech companies, they're pouring billions of dollars into AI. And so cutting headcount and eliminating employees that they were spending money on helps offset the massive costs of that AI investment.
I am curious, Roger, particularly given your background as an entrepreneur. I mean, I understand what's going on with these gigantic companies that probably got a little bloated. So they probably have a lot more fat, if you will, to cut. I am curious about some of the smaller companies, the startups, if you will. Are you seeing evidence that they're deliberately operating leaner than maybe what we would have seen in past business cycles?
Absolutely, yes. And in those cases, it's less about the startups laying off people, but not as hiring as aggressively as startups of a previous generation. So this culture of operating lean, trying to do as much as you can with small headcount, using AI to drive as much productivity as possible with a smaller staff, this has become the norm across both big tech companies and small startups.
So this idea of operating lean and maintaining a small headcount, what does that mean for wages? Are the big tech companies and startups still paying up for AI specialty roles, or have they kind of tried to stagnate their wages as well?
Yeah, there's been kind of a tale of two cities here, where on the one hand, for most staff, wages have been stagnant for a few years, or really just kind of increasing slightly to keep up with inflation. But on the other hand, there is a very small segment of top AI employees where wages have just been going through the roof. These are your most hardest to find, most impactful AI employees. And we've all heard the stories of these multi-million-dollar pay packages for these top AI talent. And that's because with AI, these certain employees with these certain skill sets can make a much bigger impact than ever before, leveraging AI and helping companies really advance their AI direction.
All right, Roger, great stuff. Really appreciate you taking time for us here. That's Roger Lee, of course. He is the co-founder there of Human Interest, a digital 401k provider. And in his spare time, he has the passion project, Layoffs.fyi, which tracks technology industry layoffs since the pandemic. All right, coming up here, a down day for two major players in the AI space. We're going to be talking about it all day with Nvidia and CoreWeave. We're going to talk to one of the key analysts who covers this space. He'll be joining us after the break. This is The Close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with eToro. Deutsche Bank upgrading to buy. The analyst says the fintech company's risk return profile attractive and sees the potential for revenue to charge higher. Those shares having their best day since June. Up next, Instacart, BMO, raising the online grocery company to outperform, maintaining a $58 price target. The firm saying recent results show the core grocery marketplace remains healthy. Those shares having their best day since May. Meanwhile, in the opposite direction is CoreWeave, a slew of analysts lowering their price targets, including JP Morgan, lowering it down to 110 from 135, downgrading to neutral, though JPM does still see a long-term opportunity for CoreWeave after last night's earnings revealed unprecedented and mounting industry-wide pressures. Those shares down 16% on the day, and those are some of our top calls. We want to stay in the AI space because Nvidia also under pressure here on the day. This after we learned that SoftBank is selling its entire stake in Nvidia, roughly about $6 billion, and now it's going to take that cash and put it into other AI investments. Gil Luria covers this space over at D.A. Davidson as their head of technology research. All right, I know this kind of rattles folks when you see a big player like SoftBank basically cashing out. We should point out they did this once before, I think right before the pandemic, and then ended up amassing a big position. Does it concern you at all that SoftBank would pull out at this juncture?
Not at all. And in fact, I think Masa-san has talked about how he regrets the last time he sold Nvidia stock. And to your point, what's going to happen now is SoftBank is taking this cash so it can afford to invest in OpenAI, which it committed to doing so in March, now that OpenAI is a for-profit. So OpenAI can borrow money, take all that money, spend it on NVIDIA chips. So somehow this is all one big circle, and that money will go back to NVIDIA. So this is of little concern. CoreWeave is the one that is more concerning. And CoreWeave has been probably the poster child for what's concerning about this AI boom. There's a lot of good, healthy investment in AI, and CoreWeave's an example of what we would call unhealthy investment. Borrowing a lot of money to make an investment that's probably not going to have a very good return, to just inflate demand. And that's unwinding quite a bit today because even they can't continue to do this forever. They've had some missteps around some of the build out. They weren't able to deliver to OpenAI the capacity they owed them, so they have to renegotiate with OpenAI, which now has lined up other data centers from Amazon and Microsoft and Oracle, so it may not even need CoreWeave. So again, this is the bad part of the behavior that we want to go away, so we can focus on the good part of the behavior, which is Microsoft, Amazon, Google, Meta, Elon building data centers to provide us products that we are already using.
Right. We clearly know some of the winners, like an Nvidia or the other chip makers that provide the GPUs. And of course, then you've got the hyperscalers that are spending on this. What about the neo cloud companies? Is CoreWeave, for now, it's kind of the leading company we talk about, but is it too early to designate it or crown it as the big guy in the space?
No, on the contrary, I would say that CoreWeave is a business of selling $10 bills for $5. They borrow money to build data centers, and their current cost is 9%. Then they turn around and buy those data centers, but the return they're getting for it is 4%. So again, they're destroying value with every data center they build. This is like taking a margin loan and investing it in treasuries. This is not healthy behavior. And CoreWeave is the poster child for that, not for where the incremental opportunity is.
I am curious about also just this idea of borrowing, not certainly for CoreWeave, but we're actually now, of course, I mean, we've already seen some of the hyperscalers like Alphabet go to market, Oracle for that matter, go to market debt markets and equity markets in some cases to sort of fund these streams. You're comfortable with that?
No. It's one thing when we use cash on hand and cash flow to build out these data centers. These data centers are a speculative investment. For as excited as we are about AI, it's a speculative investment in a technology that is not yet paying by generating appropriate returns. So it's okay to use cash to make a speculative investment, especially for these large companies if they don't have a better investment to make. It's much more dangerous when we start introducing debt into the system. And we're only tens of billions of dollars into this debt cycle. If we start putting the hundreds of billions of dollars that OpenAI and others are asking for, and these 2 years from now we get to full capacity and we can't make those interest payments, then those companies will go bankrupt. And that's where we really have to be careful because that'll have ripple effects through the rest of the economy. So there's a healthy part of the cycle. We can invest in the AI build out, but the more this is debt fueled, high cost debt for that matter, that's the dangerous behavior that we should probably be avoiding.
Yeah, absolutely. And that's why so many people are calling for rate cuts so that at least some of that debt will be a little bit less expensive. Gil, thank you so much, as always. Gil Luria is D.A. Davidson's head of technology research. Now, coming up on the close, Juan Andrade is the CEO of USAA, and he's here discussing the launch of his Honor Through Action initiative in order to ensure veterans and their families are supported year-round, not just on Veterans Day. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlet Fu.
I just want to say that picture is very misleading. It is like freezing outside. That picture of the New York City skyline.
Oh, where it's really clear.
It looked beautiful.
Yeah, well, that's what happens in the winter.
Yeah, anyway.
It's like basically 30 degrees. You were in Chicago not so long ago where it was snowing.
Yes, it was snowing. We got a little snow this morning, I believe it or not, some flurries, and it was, Scarlet.
See, beautiful.
Walked in, for now. There it is. Anyway, a decent day in the markets. I mean, it could have been a lot worse. It looked like we were headed for a pretty big sell-off today, given some of the concerns about CoreWeave and Nvidia. But at least for right now, we're kind of just
the buy the dippers came in, and even though the ETFs, QQQ's inflows, we've seen net outflows actually for that ETF. There's a lot of questions over whether this is a buying opportunity for people who've been waiting for a moment to get in.
Yeah, absolutely. Now we should point out why we can talk about stocks today. The U.S. bond market is closed in observance of the Veterans Day. It is a day, of course, where we honor those who have served in the U.S. Armed Forces. And in that spirit, USAA is making a $500 million investment over 5 years to help those in the military community have meaningful careers, financial security, and overall well-being. Pleased to say that the CEO of USAA joins us right now, Juan Andrade, to discuss a little bit more about that initiative called Honor Through Action. And we should point out, of course, for those folks who don't know, USAA is a massive bank that primarily serves our military members and veterans. Juan, great to have you here on a day like today. Talk a little bit, not so much just about the money that you're ponying up, but why you're putting that money out there.
Absolutely, and thank you for having me, and happy Veterans Day to all of our veterans. So for us, this is our mission. We have been around for 103 years, and we were created by 25 soldiers who needed insurance. And you roll the clock forward 100 years, and now we are a Fortune 100 company that is focused on serving the military community. But for us, it's also about recognizing that there's some issues that we can help our members and the broader military community to better deal with. And those three issues are a successful career transition from active duty into the civilian world and a quality job. It's about financial security, and it's also about overall well-being. And so our commitment of $500 million over the next 5 years is really aimed at going deeper into each of these issues.
Mm-hmm. Talk a little bit about the transition from folks who are retiring from active duty in the military and presumably going into a civilian life. What type of support, I mean, beyond just the current program that you just announced, what type of support does USAA traditionally offer?
Yeah, so for our company, we have a very robust hiring program for our veterans. We essentially have an 18-month program in the company with 3 rotations of 6 months and mentorship the entire 18 months. So our service members can really understand what it's like to work in the private sector and, frankly, how their skills can transfer.
And Juan, you are USAA's second chief executive without a military background. Of course, you are a veteran in the insurance industry. So I'm curious what you have learned after you joined USAA about your particular community's needs. How are their financial demands or needs unique?
Absolutely. And look, our members are the reason we exist at the end of the day. I had the honor of serving on the USAA board for 5 years before becoming the CEO. And so for me, I've had the opportunity to observe our employees, to look at our strategy, but more importantly, to interact with our members in a very measured and intimate way, whether it's in person, via email, via video calls, et cetera. And so we have a pretty deep understanding of some of the issues that they face. For instance, with the government shutdown, we initiated a government shutdown program and funded over $400 million in loans for all of our eligible service members, in addition to additional payment relief, et cetera, with the goal of creating financial stability during this difficult time for some of those families.
And of course, you mentioned the government shutdown. As we wait for the House to pass the bill funding the government and the president to sign that bill, it's looking like the members of the government are going to miss a third straight paycheck. Can you just provide some color on how your members, how the military community is coping with these missed paychecks?
Absolutely, and I'm optimistic that the government will reopen by the end of the week. But this is one of the reasons why we initiated the government shutdown program at USAA back at the beginning of October. And as I mentioned, what we have provided is over $400 million in zero-interest loans with flexible repayment, as well as additional payment flexibility on credit cards and mortgages and auto loans, lines of credit, et cetera, to be able to help during this period of time. The military has been getting paid, but it's important to remember that about 30% of our federal workers are also veterans. So if they haven't been paid, that dual income household will be losing ground. Yeah. And so this is where we stepped in.
Juan, I want to talk about specifically a little bit more about your business. Just a couple of months ago, the company made some announcements about restructuring some of the organizational structure there, particularly around technology, putting a greater focus on what you call, quote, member value. I know that announcement was just made, I think, at early September, late August. But how much progress have you made in implementing those changes?
We have made actually quite a bit of progress. On my first day as CEO back on April the 2nd, I laid out 5 priorities for the organization. And 5 months later in September is when I reorganized the company to make sure that we had the organizational design and structure to be able to implement on those 5 priorities. So I'm very proud of what the team is doing. And ultimately, it's about putting the member first with everything that we do.
Do you anticipate that you're going to have additional job cuts based on that program?
No, I don't, not based on that program. I mean, for us, this is really about making sure we have the right structure in the company and the right people in that structure to be able to serve our members better and to provide that value that they get when they become members of our association.
All right, Juan, really appreciate you taking time for us, talking about the business, and more importantly, of course, talking about the importance, really, of helping out our military community. Juan Andrade does that as the CEO of USAA. And, I'll just take a personal moment here. Scarlett, earlier this year, one of my uncles who I was very close to, Edward Moore, Sergeant Edward Moore, passed away. And probably one of the greatest moments that I've had so far this year was going down to Abraham Lincoln Cemetery down in Elmwood, Illinois, seeing them do the full 21-gun salute for him and the pomp and circumstance. He spent a whole career at IBM and working in the tech sector, but before that, he did a couple of tours in Vietnam, and he was prouder of nothing in his life more than being a Marine. And before he died, he gave me all of his medals, and it's something that I still cherish to the day. And it's just a reminder that people choose the military for a lot of reasons,
yes.
Both personal and, more importantly, in the issue of service.
Well, we honor your late uncle and those who served the nation.
Yeah. All right, when we come back, we're going to turn back to the markets and take a look at one of the, biggest movers of the day. We're going to talk about the real. It's down on the day by about 2%, but at some point we're going to show you a daily chart, and I promise you, it'll wow you. That's coming up next on our Stock of the Hour. This is The Close on Bloomberg.
Shares of the Real are soaring after the luxury resellers beat and raise earnings report. The stock climbing to its highest level since 2021. So joining us now is Bloomberg Markets correspondent Norah Mulinda. And I was reading about how the Real's sales have grown about 10% on average over the past 18 months. So it sounds like demand for used luxury is stronger than for new goods at the moment.
Absolutely. And if you think about the economic environment that we're in right now, a lot of people are going towards second-hand options. And they still want to look nice. They still want to get the luxury goods, but they are going toward the resellers instead of going to potentially the primary ones that are shelling it out, maybe Louis Vuitton or Michael Kors or wherever you're going. They're going toward the Real for a discounted price here.
So this is something broader. So I just want to point out, I made my first purchase on the Real.
Did you really?
Like a few
For
weeks.
yourself or as a gift?
It was 2 pairs of shoes. I was disappointed in one of them.
Oh, no.
Because the condition was a little bit worse than what I thought it was. But it was my entry point. My wife spends all the time. She's probably on Real right now. But I am curious just about this idea of where the growth is. I mean, I understand they can have these one-off quarters, but I feel like this was kind of a hot stock a couple years ago, then it kind of petered out. So, I mean, did management have anything to say about how this sort of sustains itself?
Well, I mean, a lot of people are pointing toward the fundamentals here. This is a stock that just got upgraded by KeyBank. They're actually upgrading it to overweight from sector weight here. And they're really just underscoring the fact that we are in an environment where a lot of people are strapped right now. But it's also two-pronged in that, one, of course, people are going to the company because they are getting discounted prices. But also, two, it's the consumer themselves actually wanting to monetize their closet. So you are seeing people wanting to make money for themselves here, in addition to the fact that people are benefiting from their items.
So in effect, you're renting your luxury goods because you can just put it back on the secondary market. I know you were looking into short interest into Real, and the short interest right now is sitting at about 25%. So when you look at the gains that we're seeing today, how much do we think it's due to short covering?
That's always a question when we do see major run-ups like this. I mean, we're seeing the stock soaring for its best day this year. We're calling out a lot of superlatives here, its highest since 2021 if we're thinking about the level here. So that really does beg the question about what the short interest is like right now. Is there any sort of short covering? That's what I'm hearing from a lot of my sources here on Wall Street as they're speculating about potentially some of these gains coming from those who are trying to cover their short positions here.
Are there any sort of other stocks in this space that are actually moving up on the back of this, or is this kind of very specific to the Real?
No, we are looking at some of the peers, but what I also found to be interesting is the bifurcation in performance here. If you look at the Real year to date, up about 40%. But if you take a look at some of the competitors, if you think about those who are the first-hand producers, right? You look at LVMH, they're not doing as well this year, up about 11 or 12% year to date. But if you look at Capri Holdings, they own Versace, Jimmy Choo, Michael Kors, they're up only about 4% year to date. But we are seeing some of the peers, as you mentioned, like Revolve, they are rallying here on the news. So we are seeing some peers kind of seeing a sympathy rally here.
Yeah, what about like, we just got to look for TJX. I know we don't, I know that's not quite the same category as real, but isn't that why everybody loves TJX?
Oh, for
I
sure.
love TJX.
A nice budget.
You know, TJ Maxx, because you're a TJ Maxx person, right? Yeah.
Absolutely.
Yeah,
so
I don't get that place.
Romain mentioned, what? It's a treasure hunt.
But it is a treasure hunt.
Exactly why I don't get it. I don't want a treasure hunt. I want curated.
I'm here with you. I want someone else to pick it out for me.
Real is curated.
Concierge service.
What Romain was saying earlier about how, you know, it really had a moment when it first listed and then it kind of petered out a little bit. How much of that is due to the demographic that it serves? I mean, this is a very Gen Z website.
Absolutely.
And Gen Z is a little bit older now and probably buying things in a way they weren't back in 2019.
Absolutely. I mean, I think Gen Z tends to be maybe more of an unreliable group if you think about the fact that when they were younger, you're not really getting that money for yourself, but you are, as you're mentioning, seeing Gen Z starting to step into the job market. They're able to get their own income, and you are seeing them really propelling this company forward. That's what a lot of analysts are talking about during this time period.
Yeah, they like that, and they also like those premium credit cards with their rewards points.
This is true. They love a lounge.
Yeah, don't get me started on that, by the way.
That's a big bugaboo with Romain. Bloomberg Markets correspondent Norah Mulinda, thank you so much, with our stock of the hour, which is the real deal.
Do you know how many programs I'm signed up to so I can get into various lounges?
Do you know which credit card you use when you buy groceries and like what?
I'm lost. It's
there's a
too
spreadsheet
much.
that you need to consult.
I'm going to go back to simpler times. We just all walked around with like a roll of quarters in our pocket or something.
Cash. He's the cash guy. Coming up, we're going to take you to the closing bell with Michael Contopoulos, Deputy CIO at Richard Bernstein Advisors. This is The Close on Bloomberg.
I think people misinterpret the stocks going up as a bubble. However, without realizing that the demand signals are in fact much more powerful than the demand signals were in the 2000 bubble.
Ankur Crawford kicking us off to the close just about 50 minutes ago, portfolio manager over at Alger, talking about, well, an AI bubble that in her view is no bubble at all. In fact, she still sees a lot of opportunity to invest going forward.
But that's really been the question last week and this week, this kind of rethinking of where we stand with the spending on AI. And for now, people are a little bit concerned, especially as we get closer to Nvidia's results, which come out next Wednesday.
Yeah, next week. And so we saw got maybe a taste of what's going on out of CoreWeave, but CoreWeave kind of insists this is sort of a very idiosyncratic one-off issue with not being able to fulfill a contract. But there's been some great reporting about just this build out and the amount of capacity that's out there that's actually not being used. So there's certainly a gap between supply and demand, but some of that supply that's coming on still is not being used.
If you're a bear, you can find reasons to stay bearish. And you can see that the Nasdaq 100 is under pressure with tech names, chip names, software names leading the way down. The S&P 500 is up 0.3%. I didn't put the Dow on there, but that's actually up 1.25% on the back of things like Goldman Sachs and healthcare names. Treasury market, of course, closed.
Don't forget that forecast that FedEx gave at that Baird conference today, which seemed to suggest, at least in their view, a relatively decent holiday spending.
Yeah, that's true. And, you know, by all accounts, the economy is holding up. Earnings certainly have held up pretty well this earnings season.
Big time. All right, well, as we get closer to those closing bells, just about 8 minutes to get there, let's bring in Michael Contopoulos, Deputy Chief Investment Officer at Richard Bernstein Advisors. And Mike, I do want to start off, first of all, just holistically with the equity market, because, I mean, this has no doubt been a rally over the last 3 years driven by AI and this tech spend here. But is it completely dependent on that? Because, you know, on a day like today where you do see the Dow outperforming on a rare day, some of that seems to be tied to optimism about the government opening up and the, I guess, theoretical resiliency of the economy?
Yeah, I think that's absolutely right, Romain, although that hasn't been the case, as we know, since July and really all of 2025. I mean, it's one of the narrowest markets still in history, I think probably since about 1998 or 1999. And so I don't think we've really quite seen that broadening that you would expect in an extremely healthy economy. But it's good to see days like today, quite frankly, where, you know, it's not about tech, it's not about AI. And you're seeing a little bit of broadening today, and that's healthy, I think.
Well, I was speaking with one of our colleagues at Bloomberg Intelligence, and she has some great data on this earnings season, because there's been a lot of talk about how this has basically been about Mag 7 and big tech. But she kind of looked at those 493 or whatever euphemism you want to use for the rest of the cohort, and they outperformed analyst expectations big time. And I know we're not all the way through the earnings season, but that has to be encouraging.
It is encouraging. Yeah. Like to your point, you typically have the weaker reporters later in the earnings cycle, and this looks like it's going to kind of come in similar to Q2, which came in similar to Q1. So earnings are kind of hovering in terms of earnings growth, right, at a pretty steady, mid-teens type level, and that is quite healthy. We think they're going to decline from here. We think that companies are going to experience a bit of margin compression, that they have, they've either increased costs or they've started to lay off and they've maintained their margins so far. But I think that could start to slip a little bit as you get to Q4. But I also don't think it's a disaster. I mean, this is certainly not an economy that's going into recession anytime within the next quarter or two.
Executives sounded pretty upbeat about the economy this earnings season. Bloomberg crunched the data and found that mentions of the words economic slowdown or something similar during calls were at the lowest since 2007. What does that signal to you? Are they just kind of focusing on what they have visibility into, which is the here and now? Or, is this kind of their projection for 3 months, 6 months, 9 months down the road?
Well, Scarlett, it's an interesting date, 2007,
yes, it is.
As we know. And so everybody tends to be the most bullish at the worst times at the tops, right? And I think you could argue, given our view, that we are at the top of the earnings cycle, that's exactly what's happening today. I think there's a tremendous amount of optimism following the decline in April. And so much of what you're seeing in earnings estimates and on conference calls and things like that are coming with the frame of mind of 6 months ago that everything was a disaster. So everything on Wall Street, right? The pendulum swings too far one way and swings too far back the other way, and you never quite land in the middle. And right now we're in the optimism phase.
Yeah.
And that's okay. I mean, there's no reason not to be yet, but I'd be stepping forward with a foot of caution for sure.
So as we wind down an earnings season, with the exception of Nvidia next week, people will start to refocus on the macroeconomy. And Henrietta Trezavetta, investment partners, was saying that she thinks the government will reopen on Thursday, and we could get a bunch of economic data points on Friday.
Yeah.
If that all comes at once, how do investors make sense of backdated data and current data all coming at the same time?
I probably would discount it a little bit. We have a pretty good handle on what's going on with the economy right now through other sources. You have alternative data on leading economic indicators. You have ADP data. Obviously, we got some data on that today. So I don't think we have obviously earnings data, which isn't the economy, but gives you an idea of what's going on with health. You have jobless claims. So I think there's, if you're really paying attention to markets and the data, you have a pretty firm hold, I think, as to what the economy is right now. It's reasonably strong. A weakening but not weak employment picture, and earnings that potentially are peaking and about to slow but aren't collapsing.
So then this gets to this idea of what exactly is the Fed's purpose at this stage? I mean, I know we're still another 4 weeks or so away from their next meeting, but I'm just a little confused as to what that discussion even looks like when they enter that room.
It's going to be very interesting.
Yeah.
I don't think they cut in December, so I'll just throw that out there. There's really no reason for it. The Fed's own metrics on labor suggest that your neutral rate is basically 30,000 job prints a month. You're printing above that at the moment. Inflation's above target. And yes, I know maybe missed a little bit last month, but still went up. So you're going the wrong direction on inflation. You're not weak enough in employment. And as Chair Powell said, you're driving through a fog. And when you're driving through a fog, you need to pump the brakes, slow down a little bit. And that essentially means do nothing. And so I don't think if you get, I don't think of the Fed when the Fed meets next month that it's going to be any sort of, drastic policy change. And I think that could surprise markets a little bit, quite frankly, who are forecasting and ratings a cut in December and then more cuts next year.
Is there any sense here that there is still life to the steepening trade?
At this point, I would probably err towards flattening as sort of cuts are taken back out of the market. And then as a consequence of that, the bond walks out there will say, oh, growth and inflation will slow. And so you actually should get a flattening of the yield curve in that scenario. We're not convicted enough at RBA to be making a big curve bet here, but should, pressed remain, I'd say probably flattening here.
All right. Always a great conversation. Mike Contopoulos, Deputy Chief Investment Officer at Bernstein Advisors. Scarlett, counting us down to the closing bells with a close look at markets. The Nasdaq is still in the red. Those concerns about the tech spend still weighing on those shares.
Yeah, but when you look at the S&P 500, you've got 21 out of 24 sectors in the green. You have capital goods indexes and banks and software, little change at the moment. So we're continuing to move into the close with momentum here.
Healthcare leading that charge here on this Veterans Day, a U.S. bond market that's closed. A breakdown of all the equity action. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through to that closing bell with the global simulcast. We're joined right now by Carol Masser and Tim Stenovic in the radio booth. Katie Greifeld has the day off. Welcome to our audiences across all of our Bloomberg platforms. That includes our partnership with YouTube for YouTube Giggly Gus's over there in the radio booth. What's so funny?
We're trying to figure out, we're playing planes, trains, and automobiles over here. We're trying to figure out.
The locomotives on the Amtrak and Acela, are some of them diesel? Because I think
and some are electric. That's the conversation we were just having.
Because we're trying to figure out, we have to take a trip. I'm just going to say.
Nobody else is interested in this.
We have to go to Boston, and it's like, do you get on a plane?
Oh, this has been your debate all day.
It's been several days, actually.
And I think we're going with the train.
Pretty depressing.
Yeah. Okay, fascinating.
All right, well, maybe we'll have. All right, listen, the enthusiasm for the shutdown, I got to say, we felt it a little bit yesterday, but not feeling it today.
In terms of the trade, well, the Dow's surging a little bit. The S&P 500
I thought we
up
didn't like
right
the
now.
Dow.
The Nasdaq Composite under pressure. Nvidia really weighing on these indices. Scarlett.
Well, we might actually get the government reopened by Friday. Henrietta Trezevedo was saying that she thinks that the bill will be passed and signed by President Trump on Thursday, which means we could get a stream of data coming out on Friday and at least, things moving in the right direction by then.
But I'm curious about some of the labor market data. The ADP data, which seems to suggest that we're actually seeing a contraction on the labor market. And of course, some of the individual layoff notices that we've seen from some of the companies. I don't know. What is that telling us?
I don't know. I'm counting down at Nvidia earnings next week. I want to see what's going on with this AI trade. I want to hear from them, guys.
Yeah. Just a quick reminder to just give everyone an update here on some of that airline chaos today. A much better day than what we've seen over the past 4. In fact, Sean Duffy, the Transportation Secretary, speaking right now, talking about that cancellations. Right now, tracking at around 1,700. That's below the 2,000 to 3,000 that we saw over the past few days. Take a look at the chart there on your screen. An S&P 500 in the green, but only by about 0.2%. There was a big drag down because of Nvidia's drop. You saw that particularly reflected in the Nasdaq Composite, which is down about 0.25 percentage point. The Dow Jones Industrial Average, though, up 600 points, 1.2%. That's actually a record high, 47.92 and change for the Dow Jones Industrial Average. Saw healthcare stocks, FedEx, and quite a few others moving higher on the day. And the Russell 2000 squeaking out a modest gain on the day, up 0.1%.
Which makes me wonder, what does that tell us? I don't even know. Kind of wild. S&P 500, let's go back there, guys. 343 names gaining on this Tuesday. Scarlett, 158 to the downside, 2 unchanged.
Yeah, let's focus on the market cap weighted index, which is the S&P 500, rather than the price weighted index, which is the Dow. So within the S&P 500, there's only one sector in the red. It happens to be the most heaviest weighted sector, which is tech, down 0.75%. But everything else finished in the green, although industrials and utilities, little change on the day. The best performers, to what Romaine was saying, was healthcare, up more than 2%, energy and consumer staples also gaining at least 1.2%.
All right, a lot of green on that screen. All right, let's go to individual gainers, if I may. This one was pretty much top gainer in the S&P for most of the day, but here at the close, being edged out a little bit, so it's in the number 2 spot here. We're talking about Paramount Skydance. This stock up as much as 12.5%. Intraday, but closing just shy of 10%. Company rose after it raised its target for job cuts and cost-saving measures. Company planning an additional workforce reduction, aiming to achieve at least $3 billion in cost savings. It is, though, forecasting $30 billion in revenue next year and plans to invest much of that savings in the business, including $1.5 billion in additional 2026 spending for the Paramount Plus streaming service. So definitely some outperformance in that one. Check out the Real, guys, up 38%, pretty much finishing at its best levels of the session. The Company out reported EPS and sales above estimates. It also boosted its revenue guidance for the full year to beat the average analyst estimate. It's up about 40% year to date, but keep in mind probably some short covering today as 25% of the float is short. So we definitely saw investors moving into that one. And last but not least, Maple Bear. I can never say that word. Maple Bear. Maybe I should just say Instacart.
There you go.
Ticker is CART. Stock up 5% in today's session. Company posted better than expected order growth, provided an upbeat earnings outlook for the current period, indicating that demand for its core grocery delivery service has been holding strong. And we've seen that for some of the companies, Uber Tech and DoorDash. They have also seen some expansion beyond restaurant takeout into the grocery category. So we're kind of seeing and all in on that.
Okay, well, let's talk a little about some of the stocks in the red today. Decliners on my list included Nvidia, down 3%. Those shares took a hit after SoftBank sold its entire stake in the company for $5.83 billion to help bankroll AI investments. This sale coinciding with a growing debate about whether spending in big tech firms will actually produce commensurate returns, expected spending surpassing $1 trillion in the coming years. I get it. They think they can have a better return outside of the company, and maybe that got some investors in the company concerned about Nvidia today. Shares sliding by 3%, weighing on the S&P 500, responsible for actually 16.8 points to the downside of the S&P today. CoreWeave down 16.3%. It fell the most since August, this after the company lowered its annual revenue forecast. This was due to a delay in fulfilling a customer contract that was caused by a third-party data center developer who is behind schedule. The company's CEO, Michael Andrade, was on Bloomberg Technology earlier today. He did say that it's a trusted partner and trusted customer, and they still have the contract. But these are the types of delays that they are dealing with. These are the choke points that the company is dealing with. That forecast for sales in 2025 now $5.05 billion to $5.15 billion, down from a previous high of $5.35 billion. CoreWeave shares down 16.3%. And then Beyond Meat fell today 9.3%. The company's fourth quarter net revenue forecast missed the average analyst estimate. The company sees net revenue in the quarter 60 to 65 million. The Bloomberg consensus was $70.1 million.
All right, let's get to some stories on our radar. And this one we've been talking about a lot. Walgreens cutting pay for hourly workers, no longer giving many of its retail workers paid vacation time for Thanksgiving, Christmas, and some other major holidays as the company looks, to cut costs.
That's very grinchy.
For what? I don't understand this. And I feel like when we talk about the K-shaped economy, I mean, people have come on and said, well, part of it is we've got to get companies to pay workers a living wage or more.
I don't know. I understand it. I think it's a labor market story. It speaks to the fact that now it's easier to get these employees so they don't have to make the same offerings that they were making during the pandemic. It's also a private equity story.
There you go.
Okay, thank you. You
now
get to
a
the heart
private
of it.
equity-owned company, and it's
but
looking to cut
you do
costs.
realize, like, these are like kind of people in the business of customer service, and if they're not feeling good about themselves and their lot in life, are they going to treat me with a smile?
Probably not.
Can apply that to air traffic controllers.
And for that matter, and not to bang up on private equity, but we've seen this playbook before, where they buy some of these consumer products companies, or consumer-facing companies. They start cutting costs, the employees get disgruntled, people stop going to the stores, and then what?
The cash flow slows down.
Okay, seems short-sighted on me, but.
It just seems kind of rough. All right, what do you guys got for us?
You guys know about how Visa and MasterCard finally settled this 20-year litigation with retailers. And as a result, they've agreed to loosen their honor all cards policies. And what that means is if you have a Chase Sapphire card, one of those MasterCard World Elite cards, you might see your card rejected by a retailer next time you go in and try to pay for it that way.
So I'm very confused by this. So basically what they're saying is that some of these premium cards also, they charge more to the retailer for transaction costs.
Yes.
So they can just say, okay, we're not going to take Chase Sapphire, but we'll take, something lesser than that. But how do you know? It's like most people don't have 15 credit cards, Scarlett. Most people have, have 2, maybe 3. So it's like, what? Are you just not going to buy anything?
But do you is there a setting on the point of sale that allows or denies a certain type of credit card? So if somebody pulls out their phone or does a tap to pay, the card is not accepted because well, they have a setting that says we're not going to accept this.
I mean, the
higher fee
infrastructure
card.
needs to be sorted out. The technology needs to be sorted out. And of course, this needs to be finalized. But the proposed deal could allow retailers to stop accepting certain types of credit cards. And we already see this with, like, if you go to the pizzeria, for instance, or like the dry cleaner, they might say, oh, you're paying with credit card, then, I'm going to have to charge you an extra surcharge. Or in my case, they'll say, I'll give you a discount if you pay in cash.
Well, that's fine, but that's kind of like across the board. But when you start saying, okay, we're only taking certain brands of cards or certain sort of brands of brands, it's like, I'm supposed to keep track of that.
That's
and they're doing it on the premium cards, which are presumably more higher income individuals. It seems kind of odd that you would sort of, peeve them.
That's what I was thinking. The premium cards, right? That are, they have higher fees and, charging individual customers. You get all these benefits, but you pay more for it.
This is ridiculous. This is exactly why I'm just going back
firms.
to cash.
Well, look,
roll of quarters in the pocket, a wad of bills in the sock, just old school.
I think
it's like my grandfather. when he died, I found like $100,000.
I don't want to be the Walgreens cashier who encounters Romaine and his roll of quarters.
Did you say $100,000 under?
Yeah, he didn't trust banks.
Okay.
He came from a different time and place.
Sometimes that different time feels better. All right, guys, that's a wrap, right? Our cross-platform coverage, radio, TV.
If you ever wonder why some people just buy a cabin in the woods and write manifestos, I think these two stories we had today are exactly why.
Oh, boy.
So many questions. So many questions. All right, that's a wrap. Our cross-platform guys. Romaine and Scarlett continuing there on the close on Bloomberg Television. Tim and I continuing on Bloomberg Business Week Daily on Bloomberg Radio. We will see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. A closer look at day 42 of the U.S. government shutdown, the possibility of the government opening back up, and, well, what the lingering effects might be. A conversation up ahead with Nora Wittstruck, S&P Global Ratings Chief Analytical Officer for Governments. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close, a record-setting day on Wall Street, but, well, not from the names you would expect. The S&P 500 did move higher on the day, but only about a 0.2%. A big drag today coming from the tech sector, particularly from Nvidia. That weighed down the S&P, it weighed down the Nasdaq 100, and everything in between. We should point out, though, it's not there on the screen, but the Dow Jones Industrial Average did finish at a record high, up more than 500 points on the day, or about 1.2%. It was a lot of healthcare names, a lot of names, and I guess the quote-unquote real economy, if you will, doing a lot of heavy lifting here on this day. You flip up the screen there and you can take a closer look at that drag that we saw from the tech space, particularly when it came to Nvidia and CoreWeave, the neo cloud that buys a lot of Nvidia chips, turns them into GPUs, and then rents those GPUs out to others. A bit of a hiccup here in completing some of its projects, a 16% drop in that stock. Meanwhile, Apple closed at a record high on the day, up 2%, and this is largely because of the idea they haven't been spending a lot of money on AI, yet could potentially be one of the biggest beneficiaries in that space. And a bit of a bright spot out of FedEx, which has been struggling all year. They gave a presentation to investors earlier today saying the holiday season actually looking a little bit brighter for them, and you saw their shares up about 5.5% on the day. And that brings us to our top story of the afternoon. The state of play for the U.S. economy, 42 days into the federal government shutdown and just 44 days away from Christmas. While there are glimmers of hope that Congress will pass a spending bill as soon as tomorrow to turn the lights back on in Washington, there's still a bit of agita over the negative inertia of it all. Remember, executives from most of the 500 largest corporations have been upbeat with their mentions of economic slowdown dropping to the lowest in almost 2 decades. But new data today shows small business sentiment that tempered to a 6-month low. ADP data shows U.S. companies have been shedding more than 11,000 jobs per week since late September, and consumer spending right now has been slowing on a trailing 28-day basis since early August. And even if the government reopens this week or next, lengthy backlogs and delays are likely, which could take weeks to revert to normalcy. Our next guest says the shutdown could take full year GDP growth down to around 1%, an undershoot of the 1.9% economists had been estimating. She joins us right now. Nora Wittstruck is Chief Analytical Officer for Governments at S&P Global Ratings. Great to see you here, Nora.
Great to see you.
In New York, not in Washington, but let's start off on what's going on in Washington. Is there a material chance that we actually do see the government reopen within the next few days?
I think so. The Senate had their vote last night. It's gone to the House. I think, the speaker is trying to get all of the representatives back to D.C. to take the vote. You know, I think at this point, bumping up against Thanksgiving with the travel snarls that you experienced this weekend, I luckily got back from Miami safely and sound to come join you today. But I think there was just a lot of headline risk that was happening that really pushed Congress to take a vote and get going with getting the government started again.
Well, let's unpack a couple of those. One, what we saw with the airlines, and the other, what's going on with STEP. With regards to the airlines, we are seeing an improving situation, but the optics from Friday, Saturday, and Sunday certainly weren't good. And now we're hearing from the Transportation Secretary, Sean Duffy, saying now, right now, the controllers are only going to get about 70% of their back pay. I am curious that once the lights do come back on, how long is it really going to take for the air traffic system to get back to normal?
Yeah, I mean, I think, you know, there was a really big snarl in air traffic maybe last December where Southwest and a lot of airlines had big hiccups in their schedules, and it took a long time to kind of work all of that out of the system. And I think that's partly why the shutdown vote is so important, is because even if it gets back started, air traffic controllers are happy, they're getting their paychecks, you know, they're coming to work, everything gets back to 100%. It does take quite a while to sort of get that traffic evened out in all of the different airline systems.
Now, the airline situation, to a certain extent, is certainly a first world problem. A more tangible problem is what we're seeing with regards to recipients of food assistance in this country. They have not received their SNAP benefits, and this is a deliberate choice because the law says that the money is there. What happens to those people? Are they going to get some sort of compensation for what was missed, or do we just sort of start from square one when the government reopens?
Well, you know, we saw some states try to move forward with providing November benefit payments. I think Alaska and Maryland, the governors of those states, both said, we believe that we should shift our departmental resources around or potentially use our reserves to make sure those people can get their benefits. So we'll see what happens. You know, it was challenged in court. It's continuing to be paused in the Supreme Court. I think any time policy is sort of litigated through the court system, implementation and all of the sort of hubbub around it gets very difficult to unpack and sort of difficult to understand what might happen next with those steps.
Another issue also is the idea that in this shutdown, we've been dealing with this issue of tax collection, or lack thereof, if you will, certainly at the state and local level. Does that have an impact? I know technically the year is over, the fiscal year is over for most municipalities, but is there some sort of rollover effect that we should be paying attention to?
Yeah, so most people don't know this, but like if you bought a coffee today, the sales taxes collected by that retailer probably wouldn't go into New York City's coffers until late December or even January. There's a 45 to 60-day lag because they go to the state sort of does an audit, and then they, you know, remit the amount back to the local government or to the state or other states. So with that said, we're really only seeing tax collections through September that cities and states are kind of getting now. So there's no visibility on what the impact to discretionary spending really was during the shutdown. And even if people get paid the back wages that they're owed, that foregone economic activity is really what shaves a lot of the growth off to fourth quarter growth, which could come down to zero based on quarter over quarter growth of 1.5%.
Are you anticipating, or are people that you talk to anticipating that we could actually see more of an economic impact, not so much because of the actual more tangible spending, but the idea that people are kind of scared off? I mean, I've heard a lot of people basically just cancel their Thanksgiving plans, even though in theory planes might be back to normal by then, but they've just decided, why even take the risk?
I think that's right. Foregone economic activity, or people reconsidering their plans, whether it be flights, whether it be hotels, whether it just be gas, all of that, there's taxes collected on all of those things that go to state and local governments. And so that foregone activity or those revised plans can really create a hit on long-term or medium-term growth, I should say.
There's also a more practical matter here with regards to the potential deal that's on the table right now, working its way through Congress. In theory, this only pretty much just kind of is a Band-Aid through, I think, the end of January, more or less. So does that mean that we have to then start litigating this again in February?
Oh my gosh. Probably there will be another continuing resolution that likely comes up at some point before the end of January, hopefully this time, and won't lead to another shutdown, which will fund the government through another period of time.
Okay, just in time for the primary season in midterm. So maybe that'll light a fire under some of these folks. Nora, always great insights.
Thank you. Thanks for having me.
Nora Wittstruck is Chief Analytical Officer for Governments at S&P Global Ratings. When we come back here on The Close, our continuing coverage of the shutdown continues, this time through the lens of the crypto industry. Yeah, there's a story there. Kristine Smith is the president of the Solana Policy Institute. She joins us next. This is Bloomberg. All right, Bitcoin under pressure once again today with signs of fatigue mounting across several of the crypto markets. But our next guest warns of short-term disruptions to the industry due to the shutdown, but still confident that longer-term policy progress is set to resume. This is 2 U.S. senators propose a bill to shift cryptocurrency oversight from the SEC to the CFTC. Joining us right now is the president of the Solana Policy Institute, Kristine Smith, to talk a little bit more about this. And actually, quite a few things have been going on in Washington over the last few days in the crypto space, despite the shutdown. But let's first start on this potential shift to the CFTC, something I know the crypto industry, Kristine, I think has been asking for.
Yeah, well, I think what the crypto industry has been asking for is they want clarity around regulation. And during the prior administration, there was a lot of litigation, a lot of regulation by enforcement that led to a lot of uncertainty. And what Congress is working on now is a framework for how to regulate this. And one sort of school of thought has always been that the CFTC could be a very natural home for the regulation of crypto spot markets. And we did see partial draft legislation that was released by a bipartisan pair of senators on the Senate Agriculture Committee yesterday. This does lay out a framework for crypto to be regulated at the CFTC. But it does leave some important parts of the bill blank. They call them brackets in D.C., so there's more work to do on some of the critical issues. But I think it's a really important step. Now that we have this language, it can be worked on with the Senate Banking Committee.
Are you hopeful that that will actually get done in any sort of reasonable amount of time, given all of the other issues that this Congress is going to have to address when they finally reopen?
Yeah, well, Congress obviously has a lot on their plate right now. I think it's more important that Congress take their time and get this legislation right than get it done quickly and get it wrong. And so I do think there is a possibility that these bills be marked up at the committee level before the end of the year. But I think this is a debate that is going to go on into next year. There are some significant differences right now between the committees of jurisdiction, between Republicans and Democrats, between the House and the Senate. So there's a lot of work to do. But I was in meetings last week, and they are going to be continuing to work on this and moving the ball forward, even if it takes some time.
And we were remiss in not pointing out the CFTC is still basically without a leader, a permanent leader. I mean, obviously they have Caroline Pham there as the acting chair, but she's basically a holdover from the previous administration. Do we think we're going to see any sort of movement on Michael Selig's nomination to actually lead the CFTC?
Yes, actually, the Senate Agriculture Committee, which oversees the CFTC, just announced today that they have a hearing for Mike Selig to move forward on the calendar. And so that's happening. But I do think one of the other things that we will need is Republican and Democratic commissioners, because if you recall, the CFTC is a 5-person commission. Right now, it's 1. Getting Mike in will be 1 to replace Caroline, but we still need 4 more. And so you have to have people there. You have to have leadership. You cannot pass a law and hand it over to a commission that doesn't have leadership. And so I think that is something that hopefully will be happening quickly, but it does take some time to get these nominees vetted and get them voted on in the Senate before they're able to take their places at the heads of the agencies.
Kristine, there was also some interesting developments coming out of this couple of the agencies, including the IRS, with regards to crypto exchange traded products. And I am curious about this idea as we start to see more regulation or lack thereof, or just more rules, formal rules in this space here. How much further along are we in that process with regards to the tax issues that the IRS and Treasury have to address?
I mean, I think there's more work to be done. We were very excited this week. As you know, earlier this month, there were several exchange-traded products for cryptocurrencies like Solana that came online despite the shutdown. And I think what we saw was the IRS provided the complementary tax guidance that enables more institutions to jump in and invest in these products. That being said, Congress has held several hearings about doing a more comprehensive tax package. And I do think there are some issues that the IRS can act on unilaterally without new authority or direction from Congress. And so, at Solana Policy Institute, we're continuing to work on both of those paths, the legislative and directly with the IRS, and hopefully we can continue to get this clarity. We've come so far in the past year. There has been a tremendous amount of work that's been done with the Genius Act and other types of clarity, but there is more work to do. And so getting the government back open and getting the rank and file staff of the SEC and the IRS back to work is incredibly important in the policymaking process going forward. And so we were very excited, I think, as a crypto industry, to see that the government shutdown is nearly over and then we can get our federal workers back to work.
Kristine, really appreciate you taking time for us. Kristine Smith, president of Solana Policy Institute, with an eye on crypto, with an eye on Washington, and back to the markets. Earnings crossing the wire right now on Oklo, of course, a stock that had become a media darling. At one point here on the year, it was up 700+% on a year-to-date basis. It's pulled back a bit over the last few weeks. It's out with earnings, and well, as you would expect, there are no earnings. Remember, this is a company that makes those small nuclear fission reactors. It has no revenue and has been posting losses for its time as a public company. Those losses continue. A third quarter loss of 20 cents a share, wider than what the street was looking for. Operating expenses also wider than the street was looking for at $14.9 million. The shares unchanged. Meanwhile, take a look at AMD. The shares getting a stronger bid in the after-hour session. They were up during the cash session. Lisa Su, speaking at an investor event here in New York City, now saying she sees margins expanding. Gross margins of 55 to 58%. Operating profit margins above 35. When we come back, we're going to talk about retail and we're going to talk about tariffs on Bloomberg. "44 days until Christmas. High stakes right now for retailers this holiday season as both consumer and small business sentiment take a bit of a dip. This is big name brands cut back on Black Friday deals, citing tariffs and inflation. Joining us right now is Rachel Brink, general manager at Red Bike Capital, an early-stage venture capital fund. She also spent 2 decades at brands including Procter & Gamble, Estee Lauder, and L'Oreal. Great to see you, Rachel.
Thank you.
We should point out, National Retail Federation says we're going to have a pretty decent holiday season, I think up like 4%. FedEx came out today, actually said they're seeing things improving as well. I know, but holistically, when you look at sort of what spending trends are we actually looking at anything materially better this year than what we had the last couple of years?
I think where we're seeing the trend is pretty sustained. I think the growth rate this year is projected to be 3.7 to 4.2% growth, finally hitting $1 trillion in Q4 consumer spend for the first time ever. Mm-hmm. So that's a big benchmark. Down a little bit. Last year it was 4.2%, so pretty steady. But I think what's really interesting is when you look under the hood, there is really, somebody called it a tale of two wallets. There is really a big difference between the high-end, high-income households and the middle and lower-end households.
How have tariffs factored into it? I know all year long we've all been talking about tariffs, and it's hard to really know where they've shown up. There's obviously a lot of anecdotal evidence. This thing I paid $10 for a year ago is now $12. But are we seeing a real pass along of those costs from the wholesaler to the retailer to the consumer?
Not yet, and not across the board. So there is several things at play. One is obviously categories. Certain categories like electronics and furniture are much more affected than, say, food. But overall, if we had had tariffs last year during Q4, it would have represented around $29 billion that the consumer would have had to pay more.
Wow.
However, what you're seeing is, so one is categories, but the other is also how different brands and different retailers are choosing to pass or not pass along that increasing price.
Well, give me some examples of that. Just as someone who particularly shops a lot online, it's kind of interesting to see the different approaches. Some have said we're just raising prices across the board by a certain percentage. Other, it's very sort of piecemeal. And then some, you just get a surprise where you order a package from overseas and then UPS guy tells you owe them an extra $100 for the tariff. And I'm like, okay, whatever. So what are you saying?
Exactly. Yeah. So I think that you really start to see sort of the pricing power law start to work out, where it really varies. So a brand like Nike, what they've actually done is tacked on $5 to $10 just to their top styles. You have a brand like Elf, where they just added $1 across the board to every single SKU. And then you have a brand like Gap that basically is saying, we're holding out, we're not passing on the price. So I think it really depends on how the manufacturer is able to negotiate with their suppliers. Were they able to pre-purchase inventory before the tariffs hit? And just how confident they feel about consumer demand. Can they take that extra price and maintain sales or not?
It's certainly become a lot more complicated, and we talk a lot with these retail CEOs, and it's kind of interesting to see how much more they're deploying technology to try to help through that. And I do want to talk a little bit about Red Bike and some of the companies that you invest in. And some of them are, I mean, they're tech companies, but they are tied to retail.
Yes, correct. So we really, at Red Bike, we think a lot about the future of commerce and how AI is going to impact it. So if you think about across the board, the first part where AI is already significantly impacting is on what's called GEO, which is generative AI search. So we invested in a company called Athena HQ, and they are helping helping companies understand how they appear, because where you appear on generative AI searches can impact 15 to 18% increased conversion rates. We're also investing in a company.
So let me just stop you there. So if I do an AI search, that's where it's doing. So that's kind of.
So as a brand, if you're searching new glasses, right? Warby Parker wants to make sure they're showing up when you're searching for your glasses.
Okay, gotcha.
And there are certain ways that you can impact the algorithm, but it's very different to traditional search.
Gotcha. Okay.
Another company that we invested in is working with brands to create marketing assets so that they can create from one asset, they can create every size, every ethnicity, every shape. They can localize it globally. So it's a company called Flock AI. We've also invested in another company called Upstream that's working on the procurement side, so more on the using AI to manage your procurement, how companies shop. So there's a lot of impact. And then more on the shelf side, at the retail side, we invested in a company called Heddle that's looking at shelf data and understanding what's going on, and another company called Dash that's also trying to disrupt the commerce intelligence. So there's a lot of different plays of how AI across discovery, across the shopping, across the in-store experience is really impacting.
What do you think the potential clients of those companies that you talked about, what are they gravitating more so? Is it more kind of the procurement, the sort of, back of the store stuff that the consumer doesn't see, or is it, like I said, me trying to figure out what I want to buy or whether I'm going to try on a certain size?
I think the most immediate impact that we're seeing today is that AI is disrupting discovery and personalization. And so I would say that the impact of GEO, of generative AI, is something you're feeling right away today. I think that, on the other hand, if you look at the back of the envelope, so like procurement or asset creation, those really help the company's bottom line. So we're also seeing a lot of take up in those types of areas.
All right, this is fascinating. We have to get you back for a longer conversation. Rachel, really appreciate it. Rachel Ten Brink is a general partner over at Red Bike Capital, an early stage VC fund with a focus on tech and e-commerce. All right, let's take a look at some of the notable movers in the after hours trade. One of the biggest movers, and there aren't a whole lot to the upside in the after hours trade, but that is AMD. They had gotten a strong bid in the cash session, and that continues in the after hours trade as CEO Lisa Su continues to give a presentation to investors. The key takeaway here is an expansion of margins, both on a gross and on an operating basis here. Maybe a bit of ratification here that the AI spend will continue despite some of the concerns of what we heard around CoreWeave and Nvidia. Meanwhile, you take a look at Oklo. This is a relatively small company that got a big boost in its shares earlier this year, a bit of a pullback. It reports earnings just a few minutes ago. No earnings, a loss, bigger than what the analysts had expected. And the revenue side, well, still not there. It's still in development. We'll be back in a moment. This is The Close on Bloomberg. All right, no official government data, but there is private market data that does show lingering pressure in the labor market. ADP released its figures suggesting a decline in private sector jobs, in fact, about 11,000 on a rolling basis over the last 4 weeks. Now, the data comes following a wave of companies announcing plans to reduce headcount, with many citing the rise of artificial intelligence. Our next guest warns laying off people now in anticipation of AI's effects might seem tempting to today's CEOs, but most of those who do will end up regretting it. Joining us right now is Gautam Mukunda. He's a Bloomberg opinion columnist, also a lecturer at the Yale School of Management. Gautam, great to have you here. Why would they regret it? I mean, I feel like when you hear them talking about some of these layoffs, they're saying, look, we're seeing higher productivity. We can operate leaner. Why do we need all these extra folks?
So the thing is, at some point in the future, they might not need all those extra folks. But right now, no one really knows how to use these tools in a way to sort of get optimal benefit from them. And that is not going to be a short process. There's going to be a lot of learning, a lot of experimentation, a lot of trying new things, a lot of innovation. In order to use this innovation, we're going to have to innovate. And the problem is that when you lay people off, anyone who's gone through a layoff knows this viscerally, right? You get scared, you get risk averse, you lose morale, you look for another job. That's exactly the environment where people stop innovating. So if you're like, well, I can get rid of these people because, I won't need them, you're also diminishing your own capacity to learn how to use these tools most effectively. You might be sabotaging your own efforts.
I am curious about that then. I mean, when you look at least what we know publicly about some of the AI rollouts, and I'm not talking about the companies doing the AI build out, but the companies that in theory are going to benefit it in terms of productivity. Do you think these CEOs and other executives have been pragmatic enough in what they've articulated, how they're going to use this, how they want their employees to use it, and what the actual benefit is?
I would have to say pretty strongly no, because we keep getting all of these data points coming out that these experiments with AI aren't working for a huge fraction of these companies. The best study we have came out of MIT, where they surveyed sort of C-suite people at different companies and reported that 95% of these experiments generated zero ROI, right? Not insufficient, but zero. So when you're at 95% at zero, like you are not deploying these well, and that's okay because that's what happens when you learn.
Right.
You go back in history when we electrified factories. That wasn't a drop-in. People didn't take the old factories and just put electric motors and conveyor belts in and things like that. You had to redesign your entire set of processes from the ground up. If this technology is as powerful as its proponents say it is, that's what we have to do, and we haven't even started.
But there's also this idea of a shift in jobs. Like we talk about, say, the dot-com boom, right? And that was the same thing. We saw a lot of layoffs in that space. But there are more people employed, even on a per capita basis today, than there was then. So it wasn't so much job loss. It was more of a job transition, if you will. How hard do you think this transition would be?
I suspect it's going to be quite hard. But it could be better. But it's be better if I would say if companies and CEOs and society kind of says, we're going to have to think through this transition as opposed to sort of acting preemptively. And if your behavior is, I'm just going to fire people because I assume that these tools are going to work, that's going to make that transition a lot harder than it has to be.
I do want to get your thoughts. I mean, you are an expert in leadership, particularly corporate leadership, but I do want to just ask you a little bit about what's going on in Washington right now. There's been a lot of backlash to a deal that Senate Democrats made to potentially reopen the government, and a lot of voters, Democratic voters, I should say, who are looking at their party and wondering what's going on. When you look at the leadership in Washington, or lack thereof, and I'm talking on both sides here, I mean, what do you think can be done to make that a little bit more responsive to actual real people, rank and file people out there who have been dissatisfied with both parties now for quite some time?
Yeah, last book was on the presidency, so this is home front for me. I think there are a few things. One is you are seeing the Democratic Party sort of adjust, right? Like, it is impossible for me to imagine that this shutdown would have gone for 40 days without the sheer distilled rage of the Democratic base at their leadership. Because every Democratic senator knew this was how it was going to end. Right? The Republicans were never going to yield. They were going to inflict pain on people that Democrats care a lot about, and then they were going to fold. This is always how it was going to end. So we did 40 days to make the base happy. But the other thing is, like, the base's objection is, it's not wrong. Like, these are people who seem to be kind of out of touch with the modern media environment and with how to handle this sort of, social media, internet-enabled political world that's just very different from what they grew up in. So my best guess is Chuck Schumer's not going to be Senate Majority Leader for much longer.
But on that point, though, I mean, I understand that we all kind of knew this was going to be a messy ending, whether it was 10 days, 50 days, whatever. But go back to 35 days or 34, whatever it was, the day before the election that we just had, where we saw Democratic victories in Virginia, New Jersey, and obviously a progressive victory here in New York City. Do you think that if we hadn't had those victories, that the Democrats would have maybe folded then, or maybe held the line a little bit longer? What?
If we hadn't had those victories, I think they would have folded earlier, because they would have said this is not working in the most direct of all possible ways. But now that they had them, I think what you're really seeing is the people who won and the next wave of Democrats who are sort of challenging incumbents right now in 26, they aren't like there's total unanimity that this was a fiasco.
Yeah.
Right? Like Seth Moulton came out the day, within seconds and said, if Ed Markey is still supporting Chuck Schumer, then he's behind this.
Yeah.
And I think you're going to see across the board, the Democratic base has lost patience with its leadership in a way that's going to force turnover.
How many parallels do you see right now between what's going on with the Democrats and their base and what we saw a decade or so ago with the Republicans and their base in that far rightward move, as you saw a lot of disaffected Republican voters looking at the centrists and saying, you're not giving us what we want?
So the shift in the Democratic Party is not, I think, ideological, it's attitudinal. So you're Mamdani here in New York was very far on the left, but Spanberger and Sherrill were not. What you're seeing, I think, in the Democratic Party is not a shift toward the left or right. It's a shift from people who think that this is not normal politics, and Trump cannot be opposed through normal politics. That's not a left-right shift. That's a do I want to fight or do I want to negotiate shift.
All right, Gautam, I have to leave it there. Gautam Mukunda is a lecturer over at Yale School of Management. He's also a Bloomberg opinion columnist. His latest column is on AI and the jobs market. All right, we're going to make a pivot here on the show. It is Veterans Day here in the United States, and we've been talking about the contributions of our service members to this country and, of course, those who also give back to those service members and their family. When we come back, we're going to have a conversation with Frank Larkin. He's the Possible Foundation board member and chairman of National Warrior Call Day. We're going to talk about what's going on in the military community and ways to protect our service members when they're serving and, of course, when they've retired. That's coming up next here on The Close. You don't want to miss that conversation. This is Bloomberg.
With the government shutdown, we initiated a government shutdown program and funded over $400 million in loans for all of our eligible service members, in addition to additional payment relief, et cetera, with the goal of creating financial stability during this difficult time for some of those families.
Juan Andrade there, the CEO of USAA, a large financial institution with about 14 million members, primarily military and their families. He talked a lot about providing relief to some of those military members during the shutdown. And we use that as an opportunity to talk about this Veterans Day and other ways that other folks are also trying to help veterans and their family. Our next guest is Frank Larkin. He's an advocate for veteran suicide prevention. He's the chairman of National Warrior Call Day and a board member for the Impossible Foundation, which is focused on preventing at-risk military from taking their own lives. He's also held several posts within the Department of Defense and a former Navy SEAL. Frank, I appreciate you being here on this day. I do just want to start off talking about the trauma coming out of the military for our veterans. And we've talked a lot in the past about PTSD and other sort of ailments that maybe lead some members to consider their own lives and whether they want to be here. Talk a little bit about what help you can give those people so that they don't get to that extreme point in their life.
Well, thanks, Romaine, and for the opportunity to be here today. You know, I'm representing the Impossible Foundation and the National Warrior Call effort, as you mentioned. The Impossible Foundation is an endowment-like platform that's looking to invest in those programs that potentially have the greatest impact on the health of our veterans. Many of them who, after 20 plus years of persistent conflict, are wrestling with both visible and invisible wounds. We're primarily focused on looking at the invisible wounds, the ones that don't appear to be obvious, that obviously are on the inside of many of these warriors and veterans that have served this nation. It's a complex rubric of the PTSD, the post-traumatic stress disorder, moral injury, which we don't talk about a lot because what they see and experience. Substance use disorder because of the pain that most of them are in, whether it's physical, mental, or spiritual. And then a growing body of evidence that's pointing to undiagnosed traumatic brain injury, much of it related to blast exposure from our own weapon systems and from explosives.
Talk a little bit more about that and how you assess what those brain injuries are and what the treatments could potentially be.
Yeah, the problem, great question. The problem that we have is that our current imaging technology and blood marker platforms cannot see this or detect this in a living person. We're working very hard. We're putting a lot of emphasis on developing technology that potentially could see this. But this shares much of the same challenges that you see in CTE, impacting the professional sports, the contact sports. It's a different pattern of injury than CTE, one that's unique to blast exposure, but we're handicapped in both domains because we can't see it in a living person. It resides at the microscopic level.
You know, we've been talking a lot on this show today about artificial intelligence, and typically when we talk about it, it's, about, whatever chatbot we can use to sort of plan our vacation or whatever else. But you actually see some potential for AI to actually help with regards to your efforts in trying to diagnose and treat these brain injuries. Yeah, absolutely. The AI can help us reflect against a normative library as we eventually get this technology online, where we potentially, our goal is to see the evolution of this disease or injury process earlier as opposed to later when it gets to a catastrophic level of damage. Unfortunately, I lost my Navy SEAL son a little over 7 years ago as a result of undiagnosed brain injury uniquely related to the blast exposure. The AI will help us check our math. It will help to illuminate things that or connections that we may not immediately see, and also I think be invaluable in modeling a lot of the trajectory that we potentially could use to prevent this on the front end. Are you getting support from the military on this? Are they supportive? Especially within the Special Operations Command. The various components, whether you're talking about Navy SEALs, which I'm a former SEAL, Green Beret, the Rangers, the Marine, Special Operations elements, are taking this very seriously. And the reason is we've lost too many operators to suicide. It's at an epidemic level. And this is unsustainable unless we start finding answers as to what, how this is affecting our brain health, let alone the body in total, and develop solutions that maintain and guarantee our operational effectiveness on the battlefield is absolutely paramount in any solutions that we come up with. What do you hear from when service members or retired service members come to talk to you? What is like the one thing that they sort of bring up with you or ask you? I will go back to what my son said. Something's wrong with my head. Nobody's listening. They keep telling me I'm crazy. And in the end, he was right. There was something wrong. He had a brain injury that was undiagnosed. I think that the greatest call out that we hear from veterans is no one listens. We're quick to judge. We're quick to hang labels. This, in and of itself, takes chunks out of a person's dignity. And what we're trying to do, especially with the National Warrior Call effort, is defeat that isolation that comes when you feel like you're not being listened to, that you are becoming, disconnected from your tribe, so to speak. Well, Frank, you're listening, and that means a lot to a lot of folks out there, not only for those service members, but family members of service members like myself. Frank Larkin is the Impossible Foundation board member and chairman of National Warrior Call Day.